My name's Eric Wilkinson. You're here with Pro Trader Strategies. What we are, we're an educational company, and what we're going to do is we're going to teach you how to trade options. So if you're new to this, please hit that subscribe button so that you get notifications when we're doing these videos. It will give you a notification if you hit that subscribe button going forward, because we are here to educate you folks on how to trade options. Also, smash that like button. It really does help us out. And finally, throughout this video, comment over there at the comment section. I want to make sure you folks are clear of the concept before we move forward with anything else. So make sure you go over there. I'm going to be keeping my eye on it, so I'll be answering your questions throughout. And in this video, we're going to talk about a little bit about swing trades, how to find and spot those setups for those swing trades. And then we're going to be looking at option strategies, looking at the internals of that underlying we have a directional assumption in, and find the best option strategy for our directional assumption. If it's bullish, we don't just go out and buy a call, folks. What we do is we have to look at the pricing and determine if it's expensive or cheap before we move forward there. And I'm Eric Wilkinson. You very well may recognize me as the Wolfman from mainstream media. I'm here to teach you guys or get you guys to a place where options just make sense. And I've geared this specific course to introduce traders and investors to options, and I'm even sure this old floor trader can teach the savviest of traders a thing or two. And options can be intimidating, I'm not going to lie, but in these videos, I'm going to build from simple concepts to real life examples. By the end of all of this, you folks should have a solid understanding of options. My goal is to get you guys to a place where you understand options intuitively, and I believe that I can do that for you quickly. All right, so without further ado, let's get on with the show. Moving on, let me share my screen, and there we go. All right, so like I said, this is our webinar on swing trades using options. These are for the bullish moves. We're already past the bullish moves. These are on the bearish moves, and we are going to be talking about the synthetic short. All right, so the poor man's covered put, which is a synthetic short, but we are going to define the risk. So it's not going to be as high risk of a trade as just shorting the underlying or going out and doing a synthetic short. This has a little bit more limited risk involved. But first, let's talk about swing trades. And what is a swing trade? Ultimately, a swing trade is anything that lasts longer than one day. So if you traded today, got in and out of a position, that's a day trade. If you got into a position yesterday and you get out of it tomorrow, that is a swing trade, believe it or not. So ultimately, with a swing trade, you want to identify an overall trend, whether it's bullish, market neutral, or bearish. Then what we want to do is look at that overall trend and find resistance areas and support areas for all of them, okay? So resistance, support, and on a bearish one, resistance, support. So first thing, overall trend, then we go for that support and resistance. Now, we are going to base our trade, our swing trade, off of the pattern within the overall trend. So in this case, we have an overall bullish trend. We've got a bullish trend here. And then inside of this, we have a bear pattern. All right. That bear pattern is going to be what we are looking for. All right. Or a bull pattern within a bull trend, ultimately. And here we have a bullish pattern within an overall neutral trend and a bullish pattern in an overall bearish trend. Okay. So we're looking for those change in momentum in our overall pattern. Okay. So we've got an overall trend, then the pattern. When we see that pattern swishing or making that move on the momentum, that's when we are looking to get involved in a trade. So ultimately, you kind of look at the charts, you can kind of squeeze your eyes in a little bit, maybe blur them so that you can kind of see it a little bit better. But what we would look at is something like this with this one, right? All right, so it's a little bit more sloppy than the original ones, but we can see there is resistance, and we can see that around that area is support. So ultimately, what we're trying to do is then find our pattern, right? It looks like we've got a bit of a topping pattern. If you zoom in on that, we've got a hammer doji at the top of a move. right? So that usually is an indication that the momentum is slowing. So that would be an opportunity to get involved in a swing trade on this because it's up against that resistance, looks like it's ready to roll over. All of those things are lining up quite nicely. But sometimes those things will break out. And in a situation like this, we're going to be talking about how we can set up trades to increase our probabilities of success. Well, one of them is not getting involved in this earnings when you get that kind of a pop. I would stay away from that all day long, folks. The reason why is because you really never know exactly where it's going to fly to if you got involved well ahead of time, all right? So how do we swing trade? We identify the overall trend. Then we are looking for those support and resistances within that overall trend. And ultimately, we are going to base our overall trade on this pattern within the trend, okay? So if we have a bullish trend, we're looking for a reversal of momentum in our underlying. So what happens? Sometimes what we'll see is all of a sudden, it'll look like it's getting ready to roll over and it'll pop up here, all right? That is something where we are playing probabilities, folks. So if you are involved in these underlyings and playing this swing trade, you need to stay mechanical with it, all right? For one, you will get used to those prices. You will get up to an area, you won't even have to look at a chart. You'll be able to know that that area is an area of resistance or an area of support. So what we're trying to do is play out the probabilities, because if you stay mechanical with it, the probabilities will work out in your favor, folks. So don't always worry about when it pops away. You blow out, get out of that position, and then retool and die. Get back into it once it's broken that pattern. So what we want to do is use these options in order to try and increase our probabilities of success. Now, I'm not going to lie, with this particular strategy, we are creating a synthetic short position, folks. And when you're creating a synthetic short position, it is going to act just like the underlying, all right? So dollar for dollar, we're going to see this underlying move positively. If we get this directional move to the bearish side, or a bearish move to the downside, I probably should say, then we will see this act like the underlying because of the way that we are going to build this strategy out. Now, know that the poor man's covered put has limited risk, okay? So it's not just like going out there and selling the naked short position. It's really kind of like going out there and selling a naked short position and then covering that trade, all right? Like adding a little bit of protection to it, all right? And I'll show you how we build all of that out here in a minute. But one of the things, if you're newer to options, let's go over this really quickly. And I thought I had this on a rotation. I did the wrong one. But let's look at call buyer. The call buyer has the right but not the obligation to buy the stock. So that means that if XYZ is trading at 100, so let's just say XYZ is trading at $100, all right? If I'm a call buyer and I buy a call at 105, all right? If I buy that call, the 105 strike, that means I have the right but not the obligation to buy that underlying at 105. If XYZ is trading 100, do I want to buy it higher? No. I have the right to buy it, but not the obligation. I don't have to. Now, if this underlying rallies up to 120 and I have the right but not the obligation to buy the underlying at 105, there is some immense evaluation in that, right? If I can buy it at 105 and sell it at 120, there is a lot of value there, okay? Now, so that is the call buyer, right? But not the obligation to buy the stock at your strike price, all right? So if the underlying is above your strike, there is value in it. If the underlying is below your strike, you can buy it cheaper, so you would do that, right? Now, the call seller has the obligation to deliver the stock, meaning I have to give my stock away to the person at that strike price. So, if I'm a call seller and I'm selling the call at 105 and it's trading 100, that seems like a pretty good deal, right? Now, if that underlying rally is up to 120, I still have the obligation to sell it at 105, all All right. So the seller has the obligation to honor the contract. All right. Now let's get over to the puts. The put buyer has the right, but not the obligation to sell that stock. So if I bought a put, right, if I buy a put at 95, I have the right, but not the obligation to sell the stock. Now, if I buy a put at 95 and it's trading 100, do I want to sell it at 95 right now? No. But if it fell down to, say, 75, and I can sell it at 95, what are you going to do? Right? There's value in that, of course, right? And on the flip side, the put seller has the obligation to buy that stock or take that delivery of that stock. Means they have to purchase it at that strike price, okay? So we're going to be using a lot of these, so make sure put buyer has the right, but not the obligation to sell the underlying. Put seller has the right, or the put seller has the obligation to take that stock, to buy it, possibly at a higher price. Everybody with me so far? All right. I hope my questions box over there is lined up. Can somebody hit up, try and throw something over there in the comment section just to see if I have something going on over there where I'm able to see the questions. I don't know if I have it turned on. You know, I'm flying a jet here, so I'm just trying to make sure. All right. All right. So when we're looking at this option prices, we have to be a good steward of capital. All right. We have to understand prices are expensive or cheap, or if they are going to get more expensive or get cheaper is really ultimately what we're going to look for when we're trading options. Now, there are certain option strategies where we can really isolate some of the negative components to an option strategy, like theta. Remember, we talked about the thief in the night if you watched any of these other videos, and I'll talk about that a little bit more as we go along here. But ultimately, what we're trying to do when we're trying to figure out if options are cheaper or expensive is really ultimately determine whether they're going to get cheaper or more expensive, okay? And how we do that is we are going to look at the options, all right? And what we really want to focus on when we're looking over here at the option montage is Vega, all right? And Vega is just implied volatility. And many of you may have seen implied volatility show up in different areas of your platform, but Vega is just a fancy word for implied volatility. And what we're looking at is these numbers increase and decrease. As they increase, the premiums go up across the board everywhere. As this number decreases, as volatility goes down, all of the prices decrease, all right? So if you're being a good steward of capital, that means you want to buy volatility when it's cheap, or buy these premiums when they're cheap and volatility is really low, and sell them when they're really expensive. I mean, that seems pretty logical, right? Problem is how do we know if these premiums, by looking at this page, if they're cheap or expensive? Well, we really can't. We have to go a little bit further than that. But another thing I also want to talk about here with volatility is when we are looking at implied volatility, that's down here. So this is our Vega. And I kind of cut off the number over there on the side. We'll talk. I got another shot that we'll be able to see that a little bit better, I think. But anyway, what we want to do is look at this little line, because even with swing trades or even this volatility, what we see is a lot of times this volatility coefficient will have a range for this underlying where it wants to stay kind of range bound, if you will. And ultimately what I'm trying to do here is try and find the highs and the lows. And I'm going basically for 6 months here because 6 months, the last 6 months is better representation of what we've been seeing as volatility for this environment. So I want to stay with the last 6 months on this. But you can see I have a bearish trend going here, and I've got a top here where we basically have two counterposing dojis. One is basically engulfing the other one, and then a confirmation today. So I'm looking for a bearish move here in FedEx. but I need to know whether or not those premiums over there in that option montage, which is where all those prices are for all the strikes, are cheap or expensive. Well, this is what I like to do, is I try to find where the high is and where the lows generally are, because that's what we see is where it finds that resistance and then the support level. So we want to find those because we know that this wants to stay within this certain range bound area. So I'm going to call this 54 on the high end. I'm going to call this on the bottom 27. I think let's call it 27, and then let's just call this 38. Okay, so we can see volatility is coming out, right? So if volatility is coming out, that means those premiums are going to start going down, right? So if I'm buying something and those premiums start going down, that will hurt me, all right? And I have a bearish assumption. What we usually see happen is with big bearish moves is volatility will have a tendency to start spiking because people are going in there and buying insurance. They're buying puts to cover their long positions, all right? So we see that premium start to jack up. So I've got a bit of a conundrum here. I have a bearish assumption with volatility looking like it's coming out. So if I'm a good steward of capital, one thing I always say is determine whether they're cheap or expensive. Well, these, in a sense, are kind of right middle of the road, pretty close. So what we do is we take the current implied volatility, and we divide or subtract that by the low implied volatility. And we take that sum divided by the range, basically, from high to low. So what this gives us is where this current spot is in relation to the high and the low. All right. So if we have 38 minus 27, we've got 11, and then 37, 20 or 70, 54 divided by 27 or 54 minus 27 is 37. And this basically is going to give us right around 37 percentile-ish. So basically, it's pretty middle of the road, but that would lead me towards they're pretty cheap. But I told you, I expect volatility to come out or be pretty cheap. So, and they're already cheap. So I've got a conundrum. Prices are cheap, but I think they might get cheaper. And if my directional move happens, they could start spiking. So I want to isolate volatility is really what I'm saying. I want to try and get rid of some volatility here. At least not worry about it too much. And then normally I would say we are looking to buy options. Well, they're cheap, but I'm worried about a couple of things with this implied volatility. So I don't necessarily want to go towards that idea that they're going to be cheap. I want to isolate some of that. So when we're looking at this and we're talking about the thief in the night, well, there's a couple of opportunities here because I want to create a situation. I have a very bearish assumption with FedEx. I think this market's going to start free falling here. So I want to be pretty aggressive with my strategy. That means I'm not going to be like, selling a call and just collecting a little premium. I want to take advantage of this move, kind of like I've got the underlying with a little bit of limited risk. So what we're going to do is we're going to set this trade up kind of like the underlying. So I'm going, and it's a bearish position. So I'm thinking I want to buy a put because I've got cheap volatility, right? So they're pretty cheap. I want to buy a put out here and take advantage of a long duration sell-off. The other thing, though, is I'm a little bit worried about is I want to limit some of my risk here, lower my overall cost basis on this. So I'm going to try and sell a put in here inside of this area. So this is the sell zone because what we see is this theta decay really ramps up inside of 35 days to expiration. So if I'm selling a put, I want to take advantage of that. And if I'm buying a put to take advantage of this long duration trade, then I want to go out here where where theta isn't affecting the premiums as much. All right. So we want to take advantage of that as well. And we can see this show up in a really good example if we show the SPY, the closer to expiration. Theta is right here. This is the thief in the night that comes and steals your premiums, right? And it's not binary, or it's not linear. It means it's not equal. It's not a dollar, a dollar, a dollar, a dollar. What it's kind of like is it's like $1, and then it's $1.50, and then it's $2, and then it's $2.50. All right. So basically, it starts increasing the further and further we go, closer to expiration. So we want to get out here with longer duration options, basically even outside of 75 days, 70 days to expiration, because we can see that theta out here doesn't increase over the course of these 60 days. 60 days. It only increases by 3 cents over this 60 days and all the way into actually almost 100 days. We only increase by 3 cents. But this next 30 days, 35 days, you can see that our valuation has increased basically by 34% or something. So it's really ramping up. So we want to buy out in this area and sell in here. We want to sell this because if we sell something high and that theta decay helps us, we start becoming profitable quickly. All right. And in our example, where we're looking at FedEx, you can still see it. Theta, this is only 1 day to expiration, but look how big theta gets the closer and closer we get to expiration. And sell zone, buy zone. You can see the difference. It's almost twice as much between those next 30 some odd days. So we want to get outside to buy in that area. All right, so I talked about this. I have a very bearish assumption. Very bearish is key, because if I'm very bearish, then I want a more aggressive strategy. And the only strategy that's more aggressive on a bearish move than this strategy is the synthetic short. All right, and we'll talk about that moving forward. But the next most aggressive is this one. But this one, the beauty in it is we carry some limited risk in here. All right. So delta is the rate of change in that options premium. I'm actually going to talk about this a little bit today, but mostly what we talk about is data, because this gives the delta basically gives us our odds of success. All right. So when you're buying an underlying, if you were going out there and selling this underlying, shorting this underlying, you basically have a 50-50 chance of success. With this one, we're going to have about closer to a 75% probability of success here with this trade. So better odds on trading with options, generally speaking, all right, most of the time. So when we're talking about this strategy, what we're going to be doing is we're going to go to that longer duration option, and we're going to be buying an 84 delta put. All right, so it's in the money. That means delta tells us for every dollar the underlying moves down, then our premiums increase by that amount. I'm going to be picking right around an 84 delta. So as the underlying goes down, my strategy increases by 84 cents for every dollar the underlying moves down. All right, on that long put. Now, though, the thing is remember, when I'm buying a put, I have the right but not the obligation. That means that if this underlying basically starts rallying and goes above my long put, I don't have to sell it there anymore, right? So I can get out for that loss, whatever the premium was. I paid a debit, I'm out for that loss, I have no more risk. If I was shorting that, though, you have continuous risk, all right? So with this strategy, it is limited risk, because when you are a buyer of an option, you're a buyer of the 84 delta option, you have the right but not the obligation to fulfill that contract or have that contract fulfilled. Now, you might be saying to yourself, well, we got a short put there. Yes, and if that short put, it's out of the money. If that short put, looks like I'm going to be in trouble, well, that's a good problem to have, because that means the underlying has really sold off and my position is 100% a winner. Okay. Even if somebody assigns me on those short puts, I have the long puts I can offset. All right. It's not ultimately the best thing that you want to do because it's very cost intensive to go through that exercise process. But nonetheless, if somebody were to stick you with the short put, then you have the long put to offset that and you can sell it much higher. Okay. So I've mentioned it a couple times. We're buying a long in the money put, and this is basically looking at greater than 70 days to expiration. All right. And the short put is less than 35 days to expiration is really the sweet spot, but sometimes you have to go out a little bit further, as far as maybe 45 days to expiration. But if you wanted to nail the sweet spot, 35 days to expiration is really what you're trying to do. So a little bit of a review real quick, though, before we move on. Swing trades, back to the swing trades. We have to identify the trend, find the support and resistance, and then ultimately find that pattern within the trend. Then we look for our options. Then we determine, yes, I can see you. All right, I just wanted to throw that out there because I wanted to make sure the questions box is working over there. Because usually you guys are pounding me with questions and being pretty quiet right now. Got me a little nervous that I have it turned off there. All right. So when we're looking at this, that's what we want to do. And we want to look at paying less than 75% the width of the spread. All right. That is best case scenario. That is a total green light. So in this case, what I'm talking about is the difference between these two strikes. All right. We're going to pay a debit. We need to figure out what that is there. And here, I screenshotted this right before I took off. So hopefully you guys can see this pretty good. So what we're trying to do here, actually, I'm just going to pull up the platform because that's not what I want to do. Hopefully the platform still has some markets in there. All right. Let's pull this platform over here. Blow this up. All right. So here's the option I want to sell. It's closest to 35 days to expiration. You can see the theta decay on here is pretty good. Now, I have the 60 days. I want to go outside of 70 days is really what I want to do. So I'm going to default out to this October. And you can see that I was looking at doing here, I'll just do it again. So ultimately, I'm going to go to around that 84 delta option, okay? It's the 350 put. Now, I want to get rid of all of the theta decay is my first step. So I want to look over here and see that basically the corresponding option, my put here, has a tell. And this is a little floor trader hat. That is pretty close to what the intrinsic or the extrinsic value of that option is. And that extrinsic value is theta decay. All right. Intrinsic value of an option is what it's worth. All right. So I want to try and pay off this $3.50. So then I just kind of scroll down here and say, all right, where can I find that strike that will pay it off? Well, it's going to be pretty close to about a 25 delta, and we're getting about a 24 delta here. All right. And so that gives me the price I want to pay for this. What I was saying with the 75% the width of the spread, what we want to do is look at the price. I paid $61.85, or I would pay $61.85 in this case. And the spread is 80 wide, right? Divided by 80. And I get 77. So it's just slightly outside of that. For some reason this morning or earlier, it seemed like it was a little bit better than that. So it's just slightly outside of that rule. So I'm going to go with it anyway. But inside, when I started setting this up earlier, it looked like it was about 75% the width. When I set this one up, 63. So the pricing got out of whack here. 63 is what I was looking at earlier today. And if I do that, then it falls within that range. 63 divided by 80. Sorry, that's not right. I screenshotted the wrong thing. What happened there? All right. Anyway. Oh, there it is. 61. Did I do that right? I think I might have done the math wrong there. Did I say it was 68? 61, or I'll just say it's 62 divided by 80. I mean, 77. So it's right there. It's pretty close. And another thing I want you guys to know with this strategy, I am doing 2 different strikes here, right? Or 2 different months. I've got one where I've got that theta decay working in my favor. That's where I'm going to sell that put, right? And then I'm trying to limit my theta by buying this put way out here. Now, I have 2 different expiration cycles here, folks. And this one worked out quite nicely. But usually, we have to look at these 2 months that I'm trading and look at their volatility coefficients. Now, if this front month is higher, which it is in this case, that means my volatility is more here than here, right? If this volatility number is higher than this one, that means these premiums here are more expensive, relatively speaking, than what we were talking about further duration, right? Because the volatility has jacked these up more, all right? So anytime you're looking at the closer duration options and they have more volatility in them, that is perfect scenario because I'm selling high and then way out, I'm buying cheap premium, all right? So that's a perfect scenario. Usually what we see is volatility increases the further out we go, all right? So what we want to make sure is that this does not increase. We want a less than a 3% increase, all right? Less than an increase of 3%. And we have a decrease here. So we don't have to worry about that decreasing volatility because I'm selling high and buying low. I just don't want to get into a situation where I am selling cheap premium up here and buying expensive premium out in time, all right? I want to avoid that situation. I have avoided that because my premiums are jacked up in this closer duration option, which is allowing me to create a wider spread here and get better probabilities on that. All right, so I have a really wide spread, $70 wide. If we start selling off, that's when I'm going to cover this trade when we are trading, when this underlying trades 270. If we go down there and trade 270, that's my short strike. I'm getting out. Why? Because I've already covered the whole width of the spread. I can't make any more money than that. So I'm just going to cover it. All right. So that's what we look to do for in that trade. Now, on a loser though, right? We know how to get out of the winner, but on a loser, what do? We need to get out. Well, you get out on the short strike, right? We've already, if it covers our complete spread, then get out, please. Don't mess around with it anymore. Just get out for whatever profit you've got there. But when we're looking at a trade like this, where I've got the breakdown below that 50-day simple moving average in this engulfing pattern, basically today is confirmation, all right? So I'm going to be looking at getting out above yesterday's high, all right? If we break above yesterday's high, I am out of this trade. And a couple of other things that I want to talk about with this one. Your max profit on this underlying is from wherever you entered this trade to zero, okay? Really is your max profit. But your max loss, the loss is infinite. Max loss is infinite. All right? Why? Because actually, that's wrong. Your max loss is not infinite. I'm sorry, folks. I started setting this up as a synthetic short, and that's not what we're doing here. We're doing the poor man's covered put. So actually, my max profit is it goes to zero because if I let, all right, I'm sorry. I'm getting ahead of myself. let me talk about this from the time that this trade is we're involved in. I paid $61 debit, right? All right, I paid a $61 debit. I have $80 wide spread. So basically, the difference between these two is my max profit. All right, so $19 on the way down is going to be my max profit. That's during the life of this short put. Now, I always say when that short put expires worthless, or you can buy it back for like 10 cents or a nickel, depending on, in and around that, basically getting into single digits. That's why I'm looking to cover that short put. I want to get out of that because then I can have all the way to zero to have my max profit, which I encourage you guys to do. Take that put off. You can even take that short put off and roll it down further, collect another credit for it, lower your overall cost basis on this trade. All right. So that's what we want to do, is lower that overall cost basis on this trade here. Let me pull this back up again, because we're going to go over and I'll look at the analyze the trade so you guys can get a better visual of this on this buy. All right, so you can see if the underlying goes down here, that is, and as soon as it goes below basically 270 is where my risk or my profit is limited because of that short put. It starts increasing value and offsetting it. That's why you cover that trade as soon as that short put is breached. Now, if it doesn't get breached and it starts getting down to a nickel or a dime, cover it and get out of that trade, folks. I implore you to do that. Roll it out further in time. This one's short at 270. So, in a perfect world, you'd be able to roll that 270 put down to maybe the 250 put, okay? Collect another credit for it and lower your overall cost basis on it. So we can see that. But if this expires, if this put expires worthless, we have our analyze tab showing that we continue to make money to zero. And then you can see if we stretch this out, it's going to curve and flatten. Why? Because that long put, if it starts trading well above where my long put is, 350, that's where I have no more risk, okay? I can only lose the amount of money I paid for this strategy. So if it spikes up and it's trading 400 tomorrow, I don't have to worry about it above that. If you were short though, and it opened up tomorrow above 400, your knees would be knocking, folks. So this is a limited risk strategy, but I will be able to benefit on the way down, especially if I continue to roll my short puts out and down. All right. We don't want to make this spread tighter and lock in a loss. Remember, your debit is $61. So I don't want to make this spread tighter than $60, right? Because then I've locked in a loss. So anytime you roll out, you want to roll out and down, all right? Not always terrible if you roll it out and as long as you're collecting your credit. Sometimes that has to happen, but try not to lock in a loss, all right? That would be, if I had to think about locking in a loss, I'd probably be thinking about locking in a pull the ripcord and get out of that trade, folks, all right? So a little bit of review here. How are we setting this trade up? We're looking for buying the 84. We want to buy this as the long in the money 84 delta put. All right. We're buying the long 84 delta put, longer duration. And then we're selling. It's going to be right around the 30 delta, guys. And it could even be closer to the 34 delta put. But that's what we're trying to do is add those two together, and that is our width of our spread. Pay less than 75% if at all possible. I'm right there at 77, so I'm at a bit of a gray area, maybe a yellow light, if you will, but I'm going to go with it because of the bearish move here that we've got set up. All right. All right. Well, then without further ado, here is your guys' offer for today. It's the Options Lab. Basically, you guys get everything. You get the entire options course, hundreds of hours for that. I don't know why this didn't show up correctly there. That is the wrong one. And I told the wrong one. So we're doing the options lab. Make sure you take advantage of that. The link is over there in the chat. You can hit on that. It'll take you directly to this. You can see everything that we have for you guys, and become a member so that you guys get access. Also, you get all kinds of stuff. If you guys want my code for finding implied volatility percent, reach out to us. We'll do that at 310-598-6677 or trading at protraderstrategies.com. Make sure you reach out to us and take a moment to go over the disclaimer, as we are an educational company. We aren't trying to get you guys to limbing off the cliff with us. We are trying to get you guys to learn what we're doing and implement it into your portfolio based on your own assumptions. All right, that's all I got for you folks. Again, please comment over there. I will be circling back around for some of you folks that are watching this on delay and making sure you guys are clear of concept. Also, make sure you hit that subscribe button so that you guys get access to these. We're going to be sending out notifications, all that good stuff. And finally, smash that like or take that. Bye for now. Take care. Take it easy.